Monetary policy is also heavily tested on the AP exam and can be understood through the cause and effect chain that shows how it's connected and affects all the impact of the economy. Let's assume that we have, well, we can see in this case we have looks like inflation in the economy because the intersection of AD and AS are operating above the full employment LRAS. So that means we're going to need some kind of expansionary fiscal policy. Most often on the AP exam, you're going to see an expansionary fiscal policy of for open market operations, which are buying and selling government bonds. When you have an expansionary, when you need to expand we have inflation, so we're going to contract the economy. When you contract the economy, you would sell bonds because that means you give the people a piece of paper, you take away their money, and that it effectively decreases the money supply. Now, when the money supply decreases, what happens is interest rates increase. When interest rates increase, the quantity of investment decreases. And we know that only investment and net exports are impacted by the change in interest rates. Some interest-sensitive components of aggregate demand are affected, like some interest-sensitive components of consumer spending and autonomous government spending, but pretty much nothing else. When investment spending decreases, we see a leftward shift of the aggregate demand curve, which causes output and price level to decrease. When output decreases, employment decreases. Now, when the interest rates increase, this increases the demand for U.S. financial assets, and that would increase or appreciate the value of the dollar, which means exports would decrease because now they're more expensive, and imports would increase, so net exports would decrease. And this pretty much is monetary policy.